When it comes to options trading, there is perhaps no strategy as well known as what among traders has come to be known as the wheel. In this lesson, you'll learn about this strategy, what it is, when to put it on, its pros and cons, and what you will need to start trading it. Also, we'll explore its mechanics in detail and we'll go through an actual example with real data taken from the option market, so you see it in action and can then determine whether it could be a good addition to your overall trading plan. The wheel is well known among option traders because of the simple and easy rules that need to be followed in order to establish it and manage it throughout its lifetime. We'll see, when we review its mechanics, that it basically consists of selling puts and calls according to a set of simple rules. Also, these rules dictate a limited number of trades, one trade for every spin of the wheel, so it's also not time-consuming to manage at all. It is a strategy that is designed to always maintain an options position open in your account. It could be a short put or a covered call. You will always have an options position on until you decide to get out of the wheel, whether at the end of one of its cycles, or mid-cycle if you so choose. The wheel is primarily a premium selling options strategy, so it will benefit greatly from a high level of implied volatility in the underlying you intend to trade. This will lead to higher premiums and potentially higher profits. This would come of course at the expense of taking on higher risks, due to the expected underlying price fluctuations the market is pricing in because of its high implied volatility. In general, however, you should always look for high implied volatility underlyings to put this strategy on. Since the wheel is based on short puts and covered calls, we can see that it is a strategy with a slightly bullish directional bias. You will always carry positive delta while you're trading it. The maximum capital that is required to trade this strategy will be equal to the maximum capital required to hold 100 shares of the underlying per option contract. Typically, this would be around 50% of the total notional amount on that position if you're trading in a margin account. This is because, as we'll see later, when the short put expires in the money, you'll be assigned a position to buy 100 shares of stock per contract at your short put strike price. The requirements for your trading account in terms of permissions are that you will need to be able to sell either naked or cash secured puts, as well as covered calls. The only difference between naked and cash secured puts is that for cash secured puts you will need to have the capital to take full assignment of the shares covered by your short put. This you'll have to do anyway to trade the wheel, so that you can cover the assignment on your short put, so there's no major difference between naked and cash secured puts when trading the wheel. You can trade the wheel on a monthly basis or even weekly or on different cycles, based on the expirations that are available for your underlying options. Keep in mind that you will need to adjust or re-establish your position after each expiration, so selecting shorter-term expirations will require you to trade more often, but will also give you more flexibility when it comes to your strike selection and adjustments. Finally, it is important to be aware of the main risk related to this strategy, which is a sustained down move in the underlying price. Since we are slightly bullish at all times, we are likely to get hurt by an underlying that is continuously going down. It is true that we are selling premium along the way, but a big down move will probably result in losses where even the premium we have received is not able to get us back to even. Along with this, and on a much smaller scale, when having a covered call on, we also have the risk that our long stock gets called away because of an upcoming dividend. Keep in mind that this is only a risk for covered calls where the short call is deep in the money. This would mean that we have basically maxed out on the profits we can get out of the position. Obviously, this would be a nice problem to have, but it does require adjustments to our overall position. We can start reviewing the mechanics of trading the wheel by defining the 2 points in the wheel's cycle where actions will be taken. The first one is the start of each iteration or spin, where the position will either be initiated or re-established. The second one is the option's expiration, which will determine our next step, based on whether it expired in the money or not. We can now see a graph showing the position's profit and loss at expiration versus the underlying price, and showing its current underlying price with a diamond and a vertical line. The first step in trading the wheel is to sell an out of the money put, which in this case we've called put number 1. We'll keep track of our position's cash flow as we go, and we can start by adding the credit received for this put, and showing the resulting position in the graph. Notice that we are showing the profit and loss line in blue at expiration, and this is so because we are going to hold this position all the way to expiration before taking the next step. At expiration, we'll determine whether our short put expired in the money, and if it didn't, like in this instance, the short put will simply expire worthless and we'll keep all the credit we received for it. At this point, we have no position anymore, but this is where the second step will need to be implemented. We are always going to re-establish the position for the wheel, right after expiration, ideally the first trading day after expiration, to capture as much credit as possible. So, even though on the graphic it looks like some time passes between expiration and re-establishing the position, in reality, this should be kept at a minimum, and ideally re-established on the first trading day after expiration. Once we are back to re-establishing our position, since we have no position anymore, we simply do another similar spin of the wheel and sell another put, which we'll call here put number 2. This generates an additional credit, and puts on a similar position to the one we had before. Now, you may be wondering whether we can just keep selling puts as long as they keep expiring at or out of the money, and the answer is yes. Ideally we could do that, and just keep collecting the premiums for those puts, but as you probably know, the market and individual underlyings rarely go up or down in a straight line, and this is where the additional set of mechanics for the wheel comes in. As we arrive at expiration for put number 2, we notice that it has actually expired in the money this time, so we are assigned a long stock position at our short put strike price. This means that we'll purchase 100 shares of the underlying for each contract in our position. This is now reflected as a debit as part of our cash flow, and we are now left with a position that is long stock at our short put strike price, which was the price we paid as part of the assignment. On the first trading day after expiration, we are ready to re-establish our position, and now we are going to take a different approach, since we are now long the underlying. Instead of selling another put, we now sell an out of the money call, which we'll refer to as call number 1. This call will bring in an additional credit, which is added to our cash flow tracker, and our position is now a covered call, made up of long stock, plus a short out of the money call. We again hold our covered call until expiration, and check to see if our short call is in the money or not. If it's not in the money, like in our current example, our short call simply expires worthless. We can then keep the credit we got for it. Things are not entirely ideal however, because we are still long the stock, and it might have gone down to a price where we are altogether maybe down, once we account for the current price of the stock, and the fact that we bought it previously, when we were assigned on our short put. When we get to re-establish our position, we apply the same logic, and since we are long the underlying, we sell an out of the money call to turn it into another covered call, and include the credit we got for this call, in this case referred to as call number 2. After we hold until expiration, and notice that our short call expired in the money, we now know that we'll be assigned on it, and our long stock will get called away. This is because, as part of the assignment, we'll sell the shares of stock we had, for a price that is equal to our short call strike price. This is added to our cash flow, and we are now left with no position at all, which we could say completes a full cycle of the wheel. We went from selling a put, getting assigned long stock, selling a call to turn it into a covered call, and finally, getting assigned on it, so it gets called away. This will generate a total profit and loss as a result of a full cycle of the wheel. At this point, you can simply keep it going with an additional cycle, and start over by again selling an out of the money put, and following the same steps we followed in this example. Now that we've traded a full cycle of the wheel, we are ready to look at a flowchart, showing your decision points and the actions you need to take to trade it. These steps are the exact same ones we went through already, but in flowchart form. This is so you always keep an eye on the big picture while trading the wheel. We start by selling an out of the money put, and holding until expiration. Here, it's important to point out that the delta you use for all the options you sell, is going to depend on how aggressive you want to be in your positions. If you want to have a high risk high reward position, you can go for higher deltas, meaning closer to your at the money, and if you want to be more conservative, you can select lower deltas or further away from the current stock price. At expiration, if our put did not expire in the money, we go back and repeat this process again by selling another put and starting over again. If it did expire in the money however, we will get assigned, and will need to buy stock at the put strike price, At this point, our position will be long stock, and we'll get ready to re-establish as soon as possible. After we have our long position, we now sell an out-of-the-money call to turn it into a covered call, which we then hold until expiration. If our short call expired at or out of the money, we re-establish after expiration by selling another out-of-the-money call, to have another covered call. If it did expire in the money, however, our existing stock will get called away, and we'll sell that stock at our short call strike price, which will leave us then with no position, and with a full cycle of the wheel already completed. It is now up to us if we want to keep it going, by re-establishing and starting over, or if we want to put an end to this position and free up capital for other strategies. Keep in mind that you can close your position at any point, even in the middle of a wheel cycle, but this will leave you with potentially some cleanup to do, by potentially having to close out options, and even your stock position, at market prices, whether advantageous to you or not at that particular point in time. For this analysis, we are going to use real market data to put on a wheel trade for Microsoft, starting on the 21st of March, with the stock at $296 and with an implied volatility of 30%. At this point, we decide to initiate a wheel trade by selling a put with a $270 strike price and an expiration date 25 days out. We sell the 13 delta put, for a total credit of $185, and this initiates our position. After reaching expiration, we notice that our short put expires out of the money, with a stock price of $279, well above our strike price of $270. This means that our short put expires worthless, and we are back to having no position on at this time. On the first day after expiration, April 18th, with Microsoft trading for $279, we sell the May 265 put, with 32 days to expiration and a delta of 29, for a $6 credit. When it reaches expiration, Microsoft is trading for $252, so our put expires in the money this time, and we are assigned long stock at our short put strike price of $265, keeping the credit we received for the short put also in our account. On the first trading day after expiration, Microsoft is now trading at $261, so we continue on with our wheel trade, by selling the June 270 call with 25 days to expiration. This call has a delta of -37, and we receive $540 for it. This leaves us now with the June 270 covered call position on Microsoft. At expiration, on June 17th, Microsoft is trading at $247, so our short call expires well out of the money, which leaves us only with our long stock position again. On June 21st, we re-establish our covered call with Microsoft trading at $253, so we sell the July 270 call, with a delta of -21, for a credit of $220. After we hold all the way to expiration, Microsoft is now trading at $256, so our short call expires worthless again, which means we are now back to having only a long stock position on. On the first trading day after expiration, Microsoft is now trading at $258, so we sell the August 270 call, with 32 days to expiration and a delta of -34, for a credit of $490. This re-establishes our 270 covered call position now for August, which we hold until expiration, where we see that Microsoft is now trading at $286, so our short call expires in the money this time. This means that we are assigned on our short call, so our stock gets called away, to be sold at $270, which was our short call strike price. This completes a full cycle of the wheel, where we can see that if we analyze the cash flow we received during this 5-month position, we end up with a profit of $25.35 per contract, as a result of the whole trade, excluding slippage and transaction costs. Now, we'll do a detailed trade analysis of this position, including all the trades we already reviewed, so we can see how we can manage our wheel trade over time. We'll start with Microsoft at $296 on March 21st, which is where we sell to open the April 270 put, for a credit of $185. This initial trade is our only trade, so it's our equivalent trade as well. Our total position still doesn't show profits or losses, since we have just started trading the wheel. Later on, our short April 270 put expires out of the money, So this leaves us with no position, and with a total cumulative credit of 185, which is also reflected as part of our total position. On the first trading day after expiration, we decide to continue on with our will trade, by re-establishing our short put, now selling to open the May 265 put, for a credit of $6. This leaves us with an equivalent position of being short the May 265 put, for a total cumulative credit of $785. Our total position at this point, is an open profit and loss of 0, using the mark-to-market value of our short May 265 put, and a realized profit of $185, because of the short put that already expired worthless. At expiration, our put is in the money, so we go through the assignment process to buy 100 shares of stock at our short put strike price of $265. This means that our equivalent position is now long stock at $257.15, once we consider all the credits we have accumulated so far. Our total position at this time shows an open loss for the long stock, of $13, and a realized profit of $785 because of the credits related to both our short puts, the one that expired out of the money, and the one we got assigned on. On May 23rd, we continue on with our will trade by following the rules, and now selling to open the June 270 call for a credit of $540. This means that we now have an equivalent position of long the June 270 covered call for a total cost of $251.75. For our total position, we have an open position of long the 270 covered call for $259.60, coming from the initial assignment at $265, and our open position where we sold to open the June 270 call for $540. When compared with the current price of $261, we are left with an open profit of $140, and a realized profit of $785, including all the credits related to already closed positions. 25 days later, at expiration, Microsoft is trading at $247, so our short June 270 call expires worthless, leaving us with an equivalent position of being only long the stock for a cumulative debit of $251.75, once we account for all the credits we have taken in since we started this will trade. Our total position is at a loss at this point, because the stock dropped so much, which highlights what we mentioned in the introduction about a sustained down move being the main risk with this strategy. The first Monday after expiration, we re-establish our position by selling to open yet another 270 call, this time for July, and taking in a credit of $220 for it. This leaves us with an equivalent position of long the July 270 covered call for a total cost of $249.55. Our total position is now profitable by $345 at this point. This is the result of an open position of a long 270 covered call for $262.80, coming from our original assignment at $265, and a credit of $220 on our still open position. When comparing this cost to the current price of $253, we end up with a loss of $980 on our open P&L, while our realized profit of $1325 comes from all the options we've already opened and closed from the beginning of the wheel trade. At expiration, Microsoft is trading at $256, so once again, our short call expires worthless, which leaves us with a long stock position for an equivalent total cost of $249.55. When compared to the current price of $256, this means that our current total position is showing a profit of $645, and changing with the current price of the underlying, since we are long those shares. On July 18th, the first trading day after expiration, Microsoft is trading at $258, and we re-establish our covered call by selling to open the August 270 call for a credit of $490. Our equivalent position now is the August 270 covered call for a debit of $244.65. We have an open position of a 270 covered call for $260.10, coming from the original assignment we had back in May, plus our open short August 270 call for $490. When compared to the current price of $258, we have an open loss of $210, which is added to our realized profit of $1545, coming from all the closed positions we've had since we started trading the wheel. Moving forward to August, at expiration, Microsoft is trading at $286, which means that our short call will expire in the money, so our long stock will get called away, and will be sold at our short call strike price of $270. This leaves us with no position anymore, and a full cycle of the wheel, already completed, netting us a total of $25.35 per contract in profit. At this point, it is up to us whether we want to keep this wheel trade going for another cycle, or if we want to deploy our capital to some other strategy, based on our overall trading plan. Now that we've analyzed real trades in a full cycle of the wheel, we can see where this could be useful to us as option traders. In this case, back in March, Microsoft was trading at $296. If we had bought stock at that price, and later on sold it in August at $286, we would have lost a total of $10 per contract. When we compare it to trading the wheel for 5 months, we see that we would have made a profit of $25.35. This does not mean that in every instance, trading the wheel is going to be a better trade than any other one. This does mean, however, that if you are expecting an underlying to be slightly bullish over time, and you want a simple but effective premium selling option strategy, trading the wheel might be a good one to know and implement when your trading plan calls for it. If you're an options trader, and you want to learn more about basic and advanced options concepts, strategies, and position management, sign up to our courses by following the links in the description below.